We designed our strategic bond fund just over 3 years ago to have a specific correlation target where we're deliberately trying to be uncorrelated to equities. And we say a maximum of plus 0.4 over a cycle. So what we're trying to do with our fund is we want to be a diversifier within a portfolio. In a big risk-off environment, you don't want your equity funds to behave like your bond funds. No, we should be making money in a big risk-off situation. But at the same time, we're global macro, we're unconstrained, we've got the ability to make money in markets, not just when the world's blowing up, but also when the economy is recovering or when, say, corporate bonds are doing well. So I think we're fully flexible, we're global unconstrained, but most importantly, we're uncorrelated to equities. I guess a strategic bond fund should always have opportunities. People have the full toolkit, the full skill set to make money really in any macro environment. So the job really for a fund manager is to get that macroeconomic view right. You want to own the bonds which are going to do well, maybe in a recession, avoid the ones that blow up if companies are going bust. On the other side, if you have very cheap assets, if everyone's panicking, you should be able to step in and buy cheap bonds as well. Our overriding global macro view is that there is a high risk of recession, which isn't a particularly controversial statement. Maybe a 1 in 3 chance of a recession or more than that in the US next year. The Eurozone right now is even close to being in a recession as we stand. The global economy is clearly weakening. What we find very interesting is different markets are pricing in different things. And what we particularly believe is going to happen is in a recession, volatility will increase. So we want to position the portfolio to actually benefit from an increase in volatility rather than be hurt by it. When we think that there's a high risk of recession or that volatility is going to return to markets across all markets, whether it's government bonds or corporate bonds, the main view we have, given where things are priced at the moment, is that corporate bonds are very vulnerable. Not just because there's lots of leverage in the system, a lot of companies have a lot of debt. Now, these companies will get exposed in a recession. And if there is a high risk of recession, you'd expect credit spreads, the extra yield in a corporate bond over a government bond, to be relatively high. But actually right now, they are near historic all-time lows. So one of our main portfolio positions is volatility will rise, but we really dislike corporate bonds and high-yield corporate bonds in particular. In terms of government bonds, we think they're probably fairly priced. They are pricing in a risk of recession. We think there is a risk of recession, so we don't have a strong view there. Within inflation, we can take inflation views around the world. We find that most markets are pricing in no inflation. And we don't think there's going to be a huge surge in inflation, but it's very, very cheap at the moment in the bond market to protect yourself against rising inflation. And finally, just in currencies, a position that we like on a structural basis is if there is, let's say, a recession or a financial crisis, currencies like the Japanese yen should do very well. And that is really what's going to protect your fund and help diversify your wider portfolio if there is a downturn in the economy or in markets.